Values. This video is based on key insights from the book Values by Mark Carney. Introduction. Mark Carney believes that building a better future depends heavily on strong leadership and a renewed focus on what truly matters, values like fairness, sustainability, and responsibility. He argues that leaders need to do more than just manage. They must inspire, explain their vision clearly, and connect with people on an emotional level to earn trust. A leader's job isn't just about being effective, it's about being ethical and building both value and good character through their actions. Carney emphasizes that companies also have a crucial role to play. He suggests that businesses should define a clear purpose beyond just making a profit, one that benefits all stakeholders: employees, customers, suppliers, and the community. A company with a strong purpose attracts better people, is more resilient during tough times, and builds stronger relationships. For example, a clothing company might focus not only on selling clothes, but also on ensuring fair wages for its workers and using sustainable materials. This approach builds solidarity at all levels, recognizing that everyone is connected. Investors, according to Carney, can be powerful forces for change. They can support companies that prioritize long-term value creation, including environmental and social impact, alongside financial returns. He advocates for better ways to measure a company's true value, considering things like diversity in the workplace and progress towards goals like the United Nations Sustainable Development Goals. Sustainable investing isn't just about doing good. It's about making smart investments that are likely to perform well in the long run. Countries, too, have a responsibility to create a fairer and more sustainable future. Carney suggests focusing on strong institutions, investing in education and skills training, and promoting competition. He believes governments should set clear goals like transitioning to a clean energy economy, and then let markets find the best ways to achieve them. However, he cautions that markets shouldn't be the answer to every problem, and that governments must protect the common good. Carney points to the importance of rebuilding social capital, the shared values and trust that hold societies together. He believes that unchecked focus on the market can erode these values, leading to inequality and instability. To counter this, he calls for a renewed emphasis on values like dynamism, encouraging innovation, resilience, bouncing back from shocks, sustainability, thinking long-term, fairness, responsibility, solidarity, and humility. Ultimately, Carney argues that we need to shift from simply valuing what things cost to valuing what they are worth. This requires a fundamental change in how we think about the economy and our place in society. He draws on Pope Francis' analogy of turning grappa, distilled, concentrated self-interest, back into wine, a richer, more complex expression of humanity. By prioritizing values alongside value, Carney believes we can create a future that is both prosperous and just for generations to come. Chapter 1: Perspectives of Value, Objective Value. Mark Carney begins by exploring how we decide what things are worth, a question that has puzzled thinkers for centuries. He points out the strange idea that something essential for life, like water, can be almost free, while something less necessary, like diamonds, can be incredibly expensive. This sets the stage for a bigger question: can everything truly be valued only if it has a price tag? He uses the recent experience of the COVID-19 pandemic to illustrate this point. While healthcare workers were rightly celebrated as heroes, their economic value was often measured by their contribution to society, a calculation that felt wrong to many. This highlights a tension between what we should value and what we do value based on money. Carney then asks why companies like Amazon are so valuable, while something vital like the Amazon rainforest isn't truly valued until it's destroyed for farmland. He wonders how we can put a price on the loss of species going extinct. These examples show that our current system often fails to account for things that are important for a sustainable future. He argues that we've increasingly started to equate monetary worth with true value, a shift that's become widely accepted in business and economics. This is a problem because it suggests that if something doesn't have a price, it isn't valuable. To understand how we got here, Carney traces the history of economic thought on value. He explains that value isn't just about economics. It's rooted in philosophy and ethics. Values are our principles, things like fairness and responsibility. Value, on the other hand, is how much we appreciate something's importance or usefulness. He distinguishes between exchange value, how much something costs, and intrinsic value, its inherent worth. Throughout history, there have been two main ideas about where value comes from: objective and subjective. Objective theories say value comes from how something is produced, while subjective theories say value comes from how much people want something. Carney then dives into the historical development of these ideas, starting with the ancient Greeks like Aristotle. Aristotle believed value was based on need, and that a just price should reflect the labor involved in making something. This idea continued through the Middle Ages with religious thinkers who also emphasized fairness and ethical considerations. They believed prices should be just and discouraged making money through speculation, seeing it as morally wrong. Over time, with the rise of trade and mercantilism, the focus shifted to national wealth and accumulating gold, sometimes at the expense of ethical considerations. The physiocrats, a group of French thinkers, believed wealth came from agriculture and land. Later, Adam Smith emphasized the importance of labor and free markets, arguing that self-interest could benefit society as a whole. However, Smith also warned about the dangers of monopolies and the need for ethical behavior. David Ricardo built on Smith's work, developing the idea of comparative advantage, which explains why countries benefit from trade even if they're not the best at producing everything. Karl Marx, building on Ricardo, focused on the labor theory of value, arguing that the value of something comes from the labor used to create it, and that workers are often exploited in the process. Carney emphasizes that these thinkers weren't just focused on economics, they were concerned with building a better society. They understood that economic systems have moral and social implications. He points out that the current tendency to equate price with value can be dangerous, as it can lead us to undervalue things that are essential for a sustainable and fair future. The chapter ultimately suggests that leadership requires a broader understanding of value, one that goes beyond simple monetary calculations and considers the long-term well-being of society and the planet. It's a call to rethink how we measure success and to prioritize values that will ensure a thriving future for generations to come. Chapter 2: Perspectives of Value, Subjective Value. Mark Carney begins by questioning how we decide what things are worth, comparing it to beauty being in the eye of the beholder. He points to the incredibly high price paid for a Leonardo da Vinci painting, even though it was heavily restored, and asks how we can value something so much when it's largely not the original work. He also mentions artist Damien Hirst's attempt to create his own currency with identical paintings, highlighting how value can be tied to exchange and even the act of valuing itself. This raises a question: what happened to creating art simply for its beauty, not for profit? Carney notes that Francis Morris, head of the Tate Modern Museum, worried that focusing too much on popular exhibits might overshadow other important work, like community programs and preserving art for the nation. She believed we should prioritize things like protecting the environment and supporting local communities. This tension between profit and purpose reflects a larger struggle within the museum, rooted in the economic ideas that began in the 19th century. These ideas shifted how we think about value, moving from focusing on what it costs to make something to what people are willing to pay for it. Carney explains this shift in economic thinking. Traditionally, value was seen as coming from the effort put into making something, like the labor involved. But the neoclassicists changed that, arguing that value comes from how much people want something. If people desire a product, then the work to create it gains value. It's not the labor that makes something valuable. It's the value people place on the finished product that gives the labor its worth. This idea, that value is subjective, has become incredibly influential. He traces this idea back through history, showing that thinkers for centuries have recognized the importance of demand and usefulness in setting prices. However, it was economists like William Jevons who truly put this idea at the center of their analysis, arguing that value depends entirely upon utility. This means something is worth what people believe it is worth, based on how useful or enjoyable they find it. Carney illustrates this with the classic water-diamond paradox. Water is essential for life, yet often cheap. Diamonds are not essential, yet are very expensive. The answer, he explains, lies in scarcity combined with how much we value each additional unit. In a desert, water becomes incredibly valuable. This thinking on the margin, considering the value of one more unit, is now a core part of how economists think. The author points out that this focus on subjective value has become so widespread that it's often assumed that any price in the market reflects true value and contributes to overall wealth. However, Carney cautions that this isn't necessarily true. He highlights the need to consider what we really value, things like sustainability, community, and education, which aren't always reflected in market prices. Carney then delves into the limitations of this dominant economic view. He explains that the idea of maximizing utility or happiness is often based on a narrow understanding of what makes people happy. Early thinkers like Jeremy Bentham focused on pleasure and avoiding pain, while others, like John Stuart Mill, recognized that people also value things like meaning, dignity, and purpose. Modern research shows that well-being is about much more than just feeling good. It includes things like health, relationships, and a sense of community. He argues that simply adding up all the things people are willing to pay for doesn't equal overall well-being. Important things like a healthy environment or a strong community aren't always priced in the market. This means that focusing solely on market values can lead to underinvestment in these crucial areas. Furthermore, Carney suggests that constantly framing everything in terms of market value could actually change our values, potentially leading us to prioritize things that are easily priced over things that truly matter. He concludes by emphasizing the need for a broader discussion about value, one that considers not just economic efficiency, but also fairness, sustainability, and the well-being of future generations. Chapter 3: Money, Gold, and the Age of Consent. Mark Carney begins by reflecting on the sheer amount of gold held by the Bank of England, questioning its purpose and highlighting the journey this precious metal undertakes. This seemingly simple observation leads him to a deeper exploration of value, not just monetary value, but the values that underpin a stable and trustworthy financial system and ultimately a sustainable future. He recounts a conversation with sculptor Antony Gormley, illustrating that the true worth often lies in the process, the act of creation, rather than simply the end result. This idea subtly introduces the concept of long-term thinking and prioritizing purpose over immediate gain. Carney then traces the history of money, from its origins in gold to its modern form as electronic transactions. He explains how gold once provided a solid foundation for currency, but that this foundation crumbled as economies grew and changed. The author emphasizes that money isn't just about numbers. It's a tool for measuring value and enabling trade. Without it, even simple tasks like getting a meal would be incredibly difficult. He stresses that money's value comes from a shared belief, a collective agreement that it holds worth. The author delves into how money is created today, explaining the role of central banks and commercial banks. He clarifies that most money isn't physical cash, but rather electronic entries created when banks make loans. This system, known as fractional reserve banking, is efficient but also carries risks. Carney highlights the importance of trust and regulation in maintaining the stability of this system, drawing parallels to historical failures like the Bank of Amsterdam, which collapsed when it strayed from its core principles. He argues that strong institutions and responsible governance are crucial for upholding the value of money. Carney emphasizes that maintaining trust requires a commitment to certain values: purpose, transparency, and accountability. He uses the example of the gold standard, explaining how it initially worked because of a shared belief in gold's value and the commitment of central banks to maintain convertibility. However, as the world changed, this system became unsustainable because it prioritized international stability over the needs of ordinary people and lacked the flexibility to adapt to new challenges. The story of Henry Austin, Jane Austen's brother, whose bank failed due to poor lending practices, serves as a cautionary tale about the importance of responsible financial management. The author then explores the evolution of money, from cowrie shells to mobile phone minutes, demonstrating its adaptability. He contrasts this with the rigid nature of the gold standard, arguing that a successful monetary system must be able to evolve with society. Carney points out that the Bank of England, like other central banks, now acts as a lender of last resort, stepping in to prevent financial crises. This role, however, requires careful judgment and a commitment to both financial stability and the well-being of the economy. Carney stresses that money is a public good, and those who manage it have a responsibility to maintain trust and protect its value. He uses the example of choosing images for banknotes, noting that the selection should inspire respect and legitimacy. He argues that the values underpinning money are just as important as the money itself. The story of the Bank of Amsterdam illustrates that even well-intentioned institutions can fail if they lose sight of their core principles. Ultimately, Carney argues that the gold standard failed not because of technical flaws, but because its values were no longer aligned with those of society. He concludes that a sustainable and fair financial future requires a commitment to transparency, accountability, solidarity, and resilience. He suggests that the choices made today about the future of money will shape the world for generations to come, and that prioritizing these values is essential for building a more stable and equitable future. The author's final anecdote about a painting of Montagu Norman serves as a playful reminder of the importance of learning from past mistakes and avoiding rigid adherence to outdated ideologies. Chapter 4, From Magna Carta to Modern Money. Mark Carney argues that understanding the history of money reveals a crucial truth. Money isn't just about numbers, it's about trust. Throughout history, successful money systems have relied on people believing in them, and that belief is built and maintained by strong institutions acting in ways that align with society's values. He emphasizes that modern money, managed by central banks, depends on this ongoing public consent, demanding transparency and accountability. Carney believes that simply maintaining the value of money isn't enough. How central banks operate and take responsibility for mistakes matters just as much. He draws a parallel to the gold standard, which ultimately failed when people lost faith in it. Carney uses the story of Magna Carta as a surprising but powerful example. While often remembered as a document about freedom, it arose during a time of economic crisis, high inflation, government debt, and public bailouts remarkably similar to challenges faced today. He argues that Magna Carta's lasting impact isn't just about political rights, but about limiting unchecked power and establishing accountability, principles vital for a trustworthy monetary system. The document showed the need for rules and fairness, even for those in charge. The author explains that the modern system of independent central banks, developed over the last century, has been remarkably effective in promoting stability and economic growth. However, this system is now being tested by economic challenges and new technologies. Carney stresses that maintaining this system requires understanding its foundations and learning from the past. He points out that the Bank of England, like other central banks, has been given significant responsibility but must operate with clear boundaries and be answerable to the public. Carney details the economic pressures that led to Magna Carta, highlighting how King John's financial mismanagement and heavy taxation fueled discontent. He explains how inflation eroded the value of fixed incomes, benefiting the wealthy who could exploit land while harming those with set payments. This historical context underscores the importance of controlling inflation and ensuring a fair economic system. He notes that even then, a lack of trust in the king's finances was a major driver of the crisis. The author emphasizes that the core principles of Magna Carta, limiting power and ensuring accountability, are directly relevant to modern central banking. Central banks must have clear goals, operate independently, and be transparent in their actions. He illustrates this with the story of the Bank of England's evolution, from its origins funding wars to its modern role in maintaining monetary and financial stability. He points out that simply having a central bank isn't enough. It must be structured to earn and maintain public trust. Carney recounts how the Bank of England gained independence in 1998, allowing it to focus on controlling inflation without political interference. This change led to significant improvements in economic stability. However, he argues that focusing solely on inflation was a mistake, as it overlooked the importance of financial stability. The 2008 financial crisis demonstrated that a healthy economy requires both stable prices and a resilient financial system. He stresses that central banks must proactively address risks and prevent crises, not just react to them. Carney believes that building trust requires more than just sound policies. It requires genuine engagement with the public. He shares his experiences visiting schools and communities, explaining complex economic concepts in accessible terms. He emphasizes the importance of diversity and inclusivity, highlighting the decision to feature historical figures like Jane Austen and Allen touring on banknotes to reflect the richness of British society. He argues that a monetary system that doesn't represent all people will struggle to gain their trust. Ultimately, Carney argues that a sustainable and fair future depends on institutions that are accountable, transparent, and responsive to the needs of the people they serve. He concludes that maintaining the value of money isn't just a technical challenge, it's a moral one, requiring a commitment to fairness, inclusivity, and long-term thinking. He believes that by learning from history and embracing these values, societies can build a more resilient and prosperous future for generations to come. Chapter 5: The Future of Money. Mark Carney begins by reflecting on times of great change, comparing the current financial revolution to the excitement surrounding innovation centuries ago. He argues that while new technologies like fintech promise a more democratic and efficient financial system, it's important not to underestimate the challenges and potential downsides. Carney points out that those already in power often miss how quickly things can change, and history shows us that revolutions only seem obvious after they've happened. He uses the example of early 20th century global finance, made possible by technologies like the telegraph, to illustrate how innovation can connect the world, but also highlights that even then, the fundamental need for reliable record-keeping, the ledger, remained crucial. Carney emphasizes that money is always evolving, and the current system of independent central banks isn't the final word. Throughout history, new ways of handling money have emerged, some successful, others not. He believes the key is to support innovations that create value while carefully managing those that could cause harm. He traces the history of money, from early banknotes in China to the bills of exchange pioneered by the Medici family, showing how financial tools have always adapted to the needs of trade. He notes that even with these advancements, the core principle of tracking transactions and assessing obligations has remained constant. The author observes that we're now in a second wave of globalization, driven by new technologies, shifting global power, and the urgent need to address climate change. The COVID-19 pandemic has accelerated these trends, pushing businesses to build more resilient supply chains and embrace digital integration. Carney believes this Great Reset offers a chance to tackle climate change and move towards a more sustainable economy. He stresses that the success of this transformation depends on technologies like mobile phones, the internet, and artificial intelligence. Carney argues that simply assuming the current system will last is arrogant. He points to the long history of monetary innovation, noting that private entities often lead the way in developing new financial tools. He uses the example of early banknotes, created by merchants to avoid carrying heavy coins, and the Medici's bills of exchange, which facilitated trade. However, he also acknowledges the risks of fractional reserve banking, where banks lend out more money than they have in reserves, and the need for central banks to oversee the system and act as a lender of last resort. He cautions that the non-bank financial sector today faces similar risks. The author highlights that the new economy demands faster, cheaper, and more accessible financial services. Consumers expect real-time transactions and seamless cross-border payments. He notes that while recent changes in payment methods like contactless cards and mobile wallets have been visible, the underlying infrastructure remains largely the same. He points to the success of companies like Ant Financial in China and Paytm in India as examples of how digital payment systems can reach a massive scale, particularly among small businesses. Carney stresses that for money to remain sound, it must be trusted, resilient, fair, inclusive, transparent, accountable, and dynamic. He believes central banks should encourage private innovation while ensuring the new system upholds these values. He warns against repeating past mistakes, like the debasement of currency, and emphasizes the importance of maintaining public confidence in money. He uses the example of the social credit system in China to illustrate how trust can be measured and potentially used to influence behavior, raising ethical concerns about privacy and control. He then examines three current innovations: cryptocurrencies, stablecoins, and central bank digital currencies, CBDCs. Carney is skeptical of cryptocurrencies, citing their volatility and limited use as a medium of exchange. He acknowledges that the technology behind them could be valuable, but believes they fall short of being true money. He sees stablecoins, cryptocurrencies, pegged to a stable asset like the US dollar, as potentially more useful, but stresses the need for strong regulation and backing to ensure their stability. He believes CBDCs, digital currencies issued by central banks, offer the best path forward, combining the convenience of digital payments with the safety and reliability of central bank money. Carney concludes that the future of money requires a balance between private innovation and public oversight. Central banks should provide a level playing field for new players while maintaining the core values of a sound monetary system. He argues that public money must remain at the heart of the system, backed by the full faith and credit of the state. He envisions a two-tiered CBDC system, where individuals have access to digital central bank money through banks or digital wallets, ensuring both efficiency and stability. Ultimately, Carney believes that a trustworthy and resilient monetary system is essential for a fair and dynamic economy, and that maintaining public trust is paramount. Chapter 6: The Market Society and the Value of Nothing. Mark Carney begins by reflecting on a childhood story about a couple who selflessly gave up their prized possessions for each other, highlighting a value system often overlooked in modern economics. He argues that while economics focuses on price, it often misses the deeper values like thoughtfulness and love that contribute to true well-being. He points out that simply giving cash wouldn't have captured the same spirit of sacrifice and connection. Carney criticizes how modern economics often treats everything as having a price, extending market principles into areas of life where they don't necessarily belong. He suggests this shift from a market economy to a market society is eroding the foundations of a fair and sustainable future. He worries that if something isn't bought and sold, it's considered to have no value, potentially damaging important social connections and civic responsibilities. The author emphasizes the importance of a social contract built on three pillars: relative equality, equal opportunity, and fairness across generations. He explains that more equal societies tend to be more stable and invest in the well-being of everyone, not just a few. Research shows that reducing inequality can actually boost economic growth, while widening gaps can hold it back. He uses examples of countries like Spain and France, where decreased inequality led to increased economic prosperity. Carney stresses that happiness isn't just about money. While income matters, Things like strong relationships, a sense of community, and good health are even more important. He notes that simply making more money doesn't necessarily make people happier beyond a certain point, and that a relentless focus on competition can actually increase stress and dissatisfaction. He points to the example of excessive testing in schools and ranking of professionals as examples of this. He argues that economics shouldn't be seen as value-neutral. Even seemingly objective economic policies are based on underlying moral choices. Carney references the philosopher John Rawls, who suggested that a just society would be designed by people who didn't know their place in it, leading to a focus on maximizing the well-being of the least fortunate. He draws a parallel to the response to the COVID-19 pandemic, where societies prioritize the vulnerable, demonstrating a willingness to embrace values like solidarity and compassion. Carney warns that the increasing dominance of markets is weakening the social contract. He explains that a healthy market relies on trust, strong institutions, and a shared sense of values. He argues that unchecked market forces can erode these foundations, leading to instability and undermining long-term prosperity. He uses the example of the financial crisis, where a lack of responsibility and ethical behavior contributed to a major economic collapse. The author highlights a shift in the balance between governments and markets, with markets gaining more influence in recent decades. He explains that while this shift initially brought benefits, it also led to a decline in social values and a focus on short-term profits over long-term sustainability. He uses the example of how policymakers began to trust market signals implicitly, believing they always knew best, which ultimately contributed to risky behavior in the financial system. Carney points out that commodifying everything, putting a price on everything, can actually change the value of things. He uses examples like paying children to read or donating to charity, arguing that these incentives can undermine intrinsic motivation and erode the sense of community. He explains that values like altruism and generosity aren't limited resources. They actually grow stronger when practiced. Ultimately, Carney argues that a sustainable and fair future requires a rebalancing of priorities. He emphasizes the need to recognize the importance of values, strengthen social connections, and ensure that markets serve the common good. He suggests that leaders, companies, and governments must prioritize ethical behavior, long-term thinking, and a commitment to building a more inclusive and equitable society. He believes that by nurturing social capital and embracing a broader definition of value, we can create a future where prosperity and well-being are shared by all. Chapter 7, The Global Financial Crisis, A World Unmoored. The chapter opens with Mark Carney reflecting on a deceptive calm in 2007, a period where the global economy seemed remarkably stable under U.S. leadership. However, even then, subtle cracks were appearing: political tensions, environmental warnings, and unsettling signals within the financial world. A seemingly minor issue in the Canadian market, asset-backed commercial paper, would quickly become a major warning sign. Carney illustrates this with a story of a central banker seeking a newspaper in Scotland, only to find that even news couldn't keep pace with the rapidly unfolding crisis. This sets the stage for a narrative about leadership failing to recognize and address systemic risks. Carney recounts receiving a frantic phone call on a summer weekend, signaling the beginning of the unraveling. The Canadian asset-backed commercial paper market was freezing up, threatening to spread chaos internationally. He emphasizes the initial confusion. The problem seemed small, distant, and difficult to grasp. This highlights a crucial leadership challenge: understanding complex systems and recognizing the significance of seemingly isolated events. He recalls a lesson from his time on Wall Street, imparted by Bob Hearst: if something doesn't make sense, it likely isn't sound. This principle, Carney argues, is vital in finance and in leadership to avoid being misled by complexity or groupthink. The author details how the financial system had become increasingly complex and detached from the real economy. Banks, driven by profit, moved away from traditional lending and embraced risky securitization and derivatives. This created a shadow banking system, operating with less oversight and greater leverage. Carney uses the example of Northern Rock, a UK bank that collapsed due to its reliance on short-term funding and risky mortgages, to illustrate the dangers of this model. He stresses that banks have a fundamental role in connecting savers and borrowers, but this role was being undermined by a focus on short-term gains and complex financial engineering. Carney points out a critical flaw: incentives were misaligned. Those making decisions weren't bearing the consequences, leading to reckless behavior. He describes how the originate-to-distribute model, where loans were quickly sold off, removed the responsibility of careful lending. This, combined with a culture of innovation without sufficient risk management, created a perfect storm. He emphasizes that a lack of understanding and a fear of appearing ignorant contributed to the crisis. People often went along with complex schemes without truly grasping the risks involved. The Canadian ABCP crisis, while small in itself, revealed a much larger problem: a web of interconnected risks hidden within the financial system. Carney explains how seemingly safe investments were backed by increasingly risky assets, and how derivatives amplified these risks. He highlights the importance of clear communication, decisive action, and overwhelming force in crisis management. He recounts coordinating a response with global leaders, including Ben Bernanke and Hank Paulson, and the need to act quickly and decisively to prevent a complete collapse. Carney shares lessons learned from navigating the crisis. He stresses the importance of recognizing that markets can be wrong for extended periods, the need for a clear plan, honest communication, and the understanding that sometimes government intervention is necessary to prevent systemic failure. He recalls a meeting with President Bush, who demonstrated humility and a commitment to addressing the crisis, which helped to build confidence among global leaders. The author concludes by reflecting on the shift away from the US-led global order and the need for a new consensus. He draws a parallel to the fall of the Soviet Union, noting that the US was also grappling with its own vulnerabilities. Carney argues that a sustainable and fair future requires a return to core values, responsibility, resilience, and solidarity, and a recognition that financial stability is essential for long-term prosperity. He suggests that leadership must prioritize these values over short-term gains and work collaboratively to build a more resilient and equitable global financial system for future generations. Chapter 8: Creating a Simpler, Safer, Fairer Financial System. Following the 2008 financial crisis, Mark Carney was given a big job: help make the world's financial system better. It wasn't just about fixing what went wrong, but building a system that was simpler, safer, and fairer for everyone. Carney understood this meant more than just new rules. It meant changing how people thought about money and risk. He believed that relying too much on complicated math and assuming people always make smart choices was a mistake. Real life is messy, and human behavior is unpredictable, leading to booms and busts. He pointed to Isaac Newton, a brilliant scientist who lost money investing because he couldn't predict the madness of people. Carney observed that the problems leading up to the crisis stemmed from taking good ideas too far. Financial innovation, which could have helped more people, instead created risky situations. People started to believe markets could do no wrong, ignoring potential dangers. This led to a lost decade for many, with incomes stagnating and trust in institutions declining. The world became more fragmented, with trade slowing down and tensions rising between countries. This highlighted the need for strong leadership and international cooperation. To address these issues, the G20 created the Financial Stability Board, FSB, with Carney later taking on a leadership role. He learned that successful global cooperation required a clear goal, political support, and the right people at the table. The FSB wasn't about creating a huge bureaucracy, but bringing together experts from different countries to find solutions. Importantly, the FSB didn't force rules on countries, but encouraged them to work together, understanding that financial problems in one place can quickly spread. Carney identified 3 common mistakes in the world of finance: believing this time is different, assuming markets always clear, and thinking markets are moral. The first mistake leads to complacency, ignoring risks because things have been good for a while. The second assumes markets always find a balance, which isn't true. Sometimes things get wildly out of control. The third assumes markets are inherently fair, which isn't the case without strong rules and ethical behavior. The G20 implemented a wide range of reforms to make the financial system more stable. Banks were required to hold more capital, making them less likely to fail. Complex financial products were simplified, and risky practices were curbed. The system proved more resilient during the COVID-19 pandemic, demonstrating the effectiveness of these changes. However, Carney cautioned against becoming complacent. Financial history repeats itself, and it's crucial to learn from past mistakes. Carney emphasized the need to address emerging risks, such as the growing debt in some countries and the potential dangers of funds that promise instant access to money while investing in less liquid assets. He also stressed the importance of strong regulation and supervision, but also of fostering a culture of responsibility and ethical behavior within the financial industry. He advocated for aligning compensation with long-term performance and holding senior managers accountable for their actions. Ultimately, Carney argued that a sustainable and fair financial future requires a shift in mindset. It's not enough to simply fix problems as they arise. We need to build a system that prioritizes long-term stability, fairness, and the well-being of society. This requires strong leadership, international cooperation, and a commitment to upholding core values like integrity, prudence, and responsibility. He believed that finance should serve society, not the other way around, and that building trust is essential for a healthy and prosperous future for generations to come. Chapter 9, The COVID Crisis, How We Got Here. Mark Carney begins by recalling a G20 meeting just before the world truly understood the scale of the coming COVID-19 pandemic. He notes a shift in tone among finance ministers, a growing worry that contrasted with the usual, somewhat detached discussions. While experts had warned of pandemic risks for years, few were truly prepared for the disruption that was about to unfold. Carney recounts a conversation with epidemiologist Peter Piot, who quickly confirmed his fears and shared modeling that predicted a devastating potential death toll, up to 250,000 in the UK alone, and a significant economic downturn. This prompted immediate action at the Bank of England, preparing for potential financial instability and developing plans to support businesses and individuals. Carney highlights the speed and effectiveness of the response led by his successor, Andrew Bailey, emphasizing how the financial system, unlike during the 2008 crisis, was able to withstand the shock. However, he points out that the health response was less prepared, relying on drastic measures like lockdowns, which tested the legitimacy of the state and demanded significant sacrifices from citizens. Carney argues that governments initially focused on the health crisis and then addressed the economic fallout, often facing difficult trade-offs. He stresses the importance of solidarity within families, communities, and between nations, but laments the lack of international cooperation. The core economic challenge wasn't just the immediate recession, but preserving the long-term productive capacity of economies and protecting livelihoods. This led to unprecedented interventions like government-supported wage schemes and emergency loans. The author identifies 5 core values essential for navigating the crisis: solidarity, responsibility, sustainability, fairness, and dynamism. He frames these values around key questions raised by the pandemic. How could this have happened? What did the lockdown reveal about our societies? What do we owe each other? Is it fair to prioritize economic limits over health? And how do we protect the vulnerable? These questions lead Carney to a discussion of the state's fundamental duty to protect its citizens. Carney traces the evolution of this duty through the work of political philosophers like Hobbes, Locke, and Rousseau, highlighting the idea of a social contract where citizens give up some freedoms in exchange for security. He notes that the state's role has expanded over time, now encompassing financial stability, environmental protection, and data privacy. Effective state action, he argues, depends on credibility, which stems from fulfilling these varied responsibilities. The chapter then delves into the concept of state capacity, the ability to create and enforce laws, provide public services, and raise revenue. Carney illustrates how this capacity has grown over centuries, particularly with advancements in understanding disease and increased fiscal resources. He points to the failures in pandemic preparedness, despite years of warnings and recommendations, as a result of undervaluing resilience and a tendency towards short-term thinking. Carney criticizes the reliance on cost-benefit analysis, particularly the practice of assigning monetary values to life and quality of life. He questions the ethical implications of these calculations, arguing that they can reflect existing inequalities and prioritize wealth over welfare. He suggests that a focus on maximizing wealth doesn't necessarily lead to a better society, and that decisions should be guided by broader societal values. Ultimately, Carney emphasizes that the COVID-19 crisis revealed a need for a more holistic approach to leadership, one that prioritizes long-term resilience, fairness, and sustainability. He suggests that a truly effective response requires not just technical expertise, but a clear understanding of the values that underpin a just and prosperous future for all generations. The chapter concludes by emphasizing that the crisis demanded compassion and a recognition of our shared humanity, rather than purely financial calculations. Chapter 10, COVID Crisis, Fallout, Recovery, and Renaissance. Mark Carney's chapter dives deep into what the COVID-19 pandemic revealed about how we respond to big crises and what it takes to build a better future. He argues the pandemic wasn't just a health emergency, but a huge test of leadership and our shared values. The initial response lockdowns, restrictions showed governments were willing to take drastic action, but also highlighted how prepared or unprepared countries truly were. Carney points out that simply having rules isn't enough. People need to trust those in charge to follow them, and that trust is built on fairness and a sense that the government is acting in everyone's best interest. He uses the example of New Zealand, where quick, decisive action and high public trust led to a successful eradication of the virus, contrasting it with the United States, where political division and distrust hampered efforts. Carney emphasizes that the pandemic exposed existing inequalities. Those with less secure jobs, lower incomes, and certain racial backgrounds were disproportionately affected by both the virus and the economic fallout. He stresses that a truly effective response isn't just about minimizing deaths, but about ensuring everyone is protected and that the burdens and benefits are shared fairly. This idea of fairness, he argues, is crucial for maintaining social cohesion and ensuring people cooperate with necessary measures. He illustrates this with examples of how essential workers, often in low-paying jobs, faced higher risks, while wealthier individuals could more easily protect themselves. The author then shifts focus to the idea of legitimacy, why people choose to obey rules. He explains that it's not just about fear of punishment, but about believing the government is acting legitimately and for the common good. He draws a parallel to historical concepts like the Magna Carta, which established limits on state power, suggesting that a history of responsible governance builds trust. Carney argues that simply holding elections isn't enough to create legitimacy. It's about whether the government delivers fair outcomes and holds itself accountable. Carney introduces the concept of values, solidarity, fairness, and responsibility, as being powerfully revealed during the pandemic. People willingly made sacrifices for others, volunteering, helping neighbors, and following restrictions even when it was inconvenient. This demonstrated a willingness to act as Rawlsians, prioritizing the well-being of the most vulnerable, rather than focusing solely on individual self-interest. However, he cautions that this spirit of solidarity needs to be nurtured and translated into lasting change. The chapter then critiques the common approach of trying to put a monetary value on life when making policy decisions. Carney argues that reducing everything to a cost-benefit analysis can be morally problematic and overlooks the importance of values like compassion and fairness. He suggests a more effective approach is to focus on achieving clear societal goals, like minimizing harm and ensuring equitable access to healthcare, and then finding the most cost-effective ways to achieve them. He uses the analogy of setting a temperature target for climate change, where the goal is to limit warming to a certain level, rather than trying to calculate the exact cost of every degree of temperature rise. Carney proposes a framework for moving forward, drawing lessons from the pandemic and applying them to future challenges, particularly climate change. He advocates for a focus on resilience, preparing for unexpected shocks, and building systems that can withstand stress. He stresses the importance of addressing economic inequalities and ensuring that the benefits of progress are shared by all. He argues that governments need to prioritize long-term sustainability over short-term gains and invest in things like education, healthcare, and green technologies. Ultimately, Carney believes the pandemic presented an opportunity to rethink our priorities and build a more just and sustainable world. He calls for a shift away from a purely market-driven society, where everything has a price, towards one that prioritizes public values and the well-being of future generations. He concludes with a hopeful vision of a future where societies are more resilient, equitable, and focused on creating a planet fit for our grandchildren. He emphasizes that leadership requires not just responding to crises, but proactively building a better future based on shared values and a commitment to the common good. Chapter 11, The Climate Crisis. Mark Carney paints a clear picture. Our planet's climate is changing rapidly, and this change is largely caused by human activity. He explains that for thousands of years, Earth enjoyed a stable climate, but the Industrial Revolution kicked off a period of warming that's now accelerating. This isn't just about warmer temperatures. It's about more extreme weather, rising sea levels, and a loss of plant and animal life at an alarming rate, potentially the sixth mass extinction in Earth's history. Carney stresses that these changes aren't distant threats. They're already impacting our economies and communities. A central theme throughout the chapter is the idea that addressing climate change requires strong leadership and a long-term perspective. Carney points out a key problem. The most serious consequences of climate change will be felt by future generations who have no voice in today's decisions. This creates a tragedy of the horizon, where short-term gains are prioritized over long-term sustainability. He uses the analogy of a ship. We're all in the same boat, and no one can escape the storm by simply moving to a different deck. Carney emphasizes that simply understanding the problem isn't enough. We need to understand the causes, primarily greenhouse gas emissions, and the consequences for our economies and financial systems. He explains the concept of a carbon budget, which represents the amount of carbon dioxide we can still release into the atmosphere without exceeding dangerous temperature thresholds. The budget is shrinking quickly, and current emissions levels are pushing us towards a future with severe climate impacts. He illustrates this with a relatable example. If we continue on our current path, future generations will have a drastically smaller carbon allowance than their grandparents did. The author highlights that the financial sector has a crucial role to play. Climate change creates both physical risks, damage from extreme weather, and transition risks, the economic disruption caused by shifting away from fossil fuels. Carney notes that insurers are already seeing the impact of physical risks, with increasing costs from storms and floods. He argues that financial institutions need to start pricing these risks accurately and investing in sustainable solutions. He points to examples like companies writing down the value of fossil fuel assets, recognizing they may become worthless in a low-carbon future. Carney also discusses the concept of stranded assets, investments that lose value as the world transitions to a cleaner economy. He uses the example of coal power plants, which may become obsolete as renewable energy becomes cheaper and more widespread. He stresses that a rapid transition is necessary, but it must be managed carefully to avoid economic shocks. He explains that the speed of technological change is accelerating, offering hope that we can develop and deploy the solutions we need more quickly. A significant portion of the chapter focuses on the need for international cooperation. Carney acknowledges the historical responsibility of developed countries for the majority of greenhouse gas emissions, but emphasizes that all nations must work together to address the problem. He discusses the Paris Agreement as a landmark achievement, but cautions that current pledges are not ambitious enough to meet the agreement's goals. He points out that the financial system needs to align with climate policies to truly drive change. Carney concludes by emphasizing that solving the climate crisis requires a fundamental shift in how we think about value. We need to recognize the importance of things that aren't traditionally measured in economic terms, such as biodiversity and social well-being. He argues that a sustainable future is not just environmentally necessary, but also economically beneficial. He calls for a new financial system that prioritizes long-term sustainability and invests in the technologies and solutions that will create a cleaner, more resilient world for generations to come. He believes that strong leadership, combined with innovation and collective action, can unlock a virtuous cycle of progress and prosperity. Chapter 12, Breaking the Tragedy of the Horizon. Mark Carney argues that tackling climate change isn't just about urgent warnings. It's about recognizing a huge opportunity. He believes we've been stuck between knowing we need to act quickly and being too comfortable to make big changes. We're using up our carbon budget, the amount of pollution the planet can handle too fast, and not valuing the damage we're doing to nature. But he suggests a shift in what society cares about. Things like working together and being prepared for tough times can help us overcome these problems. Carney emphasizes that transitioning to a sustainable economy isn't a sacrifice, but a chance for growth and jobs. It requires a lot of investment, which is good news when many people are looking for work. It's about building a greener world and connecting globally, offering a positive path forward. He believes solving this crisis requires 3 key areas: clever engineering, smart politics, and a financial system that supports change. All of these, he insists, are within our reach. The author explains that electrifying everything and switching to renewable energy sources like solar and wind are central to the plan. These technologies are becoming cheaper all the time. However, some areas, like long-distance flights and farming, are harder to fix and will need new solutions, like sustainable fuels or capturing carbon emissions. He points to the falling costs of wind energy as a success story, showing how innovation and investment can make a difference. Carney acknowledges that some industries will need to change dramatically, and some investments might become worthless. But he sees this as a chance for entrepreneurs and investors to develop new technologies to solve these difficult problems. He stresses the importance of scaling up successful technologies and making sure policies are stable and predictable to encourage investment. He argues that the biggest hurdle isn't technical, but political. It's about valuing the future and caring about the generations that will come after us. He describes climate change as a tragedy of the horizon, a problem we know is coming, but are tempted to ignore because the worst effects won't be felt immediately. He recounts a powerful speech by Greta Thunberg at the UN, which challenged leaders to do more and highlighted the urgency of the situation. Carney believes that social movements, like the ones inspired by Thunberg, are crucial for creating the public pressure needed to drive change. He notes that as more people become concerned about climate change, it's becoming a mainstream political issue. He suggests that a shift in values towards sustainability and fairness can create a virtuous circle where more investment and better policies reinforce each other. To make real progress, Carney proposes a fundamental shift in the financial system. Every financial decision, investments, loans, insurance needs to consider the impact on climate change. This requires better reporting of climate-related risks, improved risk management by financial institutions, and a shift in investment towards sustainable projects. He champions the Task Force on Climate-Related Financial Disclosures, TCFD, as a key step in improving transparency. Carney stresses the need for governments to set clear, long-term goals and create policies that support the transition to a low-carbon economy. He suggests carbon pricing, making polluters pay for the damage they cause, as a key tool, but also emphasizes the importance of investing in green infrastructure and supporting research and development. He proposes the idea of independent carbon councils to provide expert advice and ensure that climate policies remain consistent over time. Finally, Carney highlights the importance of international cooperation and ensuring that developing countries have the resources they need to adapt to climate change and transition to sustainable economies. He suggests creating new financial mechanisms to channel investment into these countries and support the development of carbon markets that allow companies to offset their emissions by investing in projects that reduce emissions elsewhere. He believes that by working together and embracing innovation, we can create a sustainable and fair future for all generations. Chapter 13, Values-Based Leadership. Mark Carney begins by acknowledging the risk in publicly discussing leadership and values, as it invites scrutiny of whether actions match words. He points out that past failures, like the overconfidence before the 2008 financial crisis, demonstrate the dangers of believing everything is going well. However, he argues that learning from the past and rebuilding values is essential for a better future. Carney explores different ideas about leadership, starting with ancient examples like Caesar and Gandhi and moving to modern management theories. Early theories focused on the qualities of leaders, but later research showed that the situation also matters. He explains Max Weber's idea of 3 leadership types: charismatic, traditional, and legal bureaucratic, and how even formal authority needs public trust to be effective. Even central bankers, he notes, need to connect with people and explain their actions. He simplifies many leadership models into 3 main categories: great person theories, leaders are born with it; behavioral theories, leadership can be learned; and participative theories, leadership involves working with others. Carney favors the latter too, believing leadership is developed and collaborative. He emphasizes that effective leadership isn't one-size-fits-all. Leaders must adapt their style to the situation, being more direct when they have expertise and more collaborative when working with skilled teams. He contrasts transactional leadership, focused on tasks and rewards, with transformational leadership, focused on inspiring a shared vision. Carney believes the best leaders do both, achieving results while also motivating and empowering others. He highlights the importance of emotional intelligence, understanding and managing emotions, for transformational leadership. Carney then addresses the current crisis of trust in institutions. He notes that people are losing faith in governments, the media, and even experts, and are increasingly turning to friends and family for information. This distrust stems from poor performance, complexity, and the spread of misinformation online. He suggests ways to rebuild trust, including greater transparency, acknowledging uncertainty, improving communication, staying focused on core responsibilities, and genuinely listening to diverse perspectives. He stresses that leaders must make decisions, even with uncertainty, and that competence is crucial for maintaining trust. Carney outlines 5 key qualities of effective, values-based leadership: purpose, perspective, clarity, competence, and humility. Purpose provides direction, perspective requires understanding different viewpoints, clarity ensures clear communication, competence builds confidence, and humility fosters continuous learning. Carney argues that leaders must define a clear purpose for their organizations, one that goes beyond profit and benefits society. He emphasizes the importance of diversity, not just in representation but in thought, and of creating inclusive environments where everyone feels valued. He advocates for leaders to challenge their own assumptions, seek feedback, and admit mistakes. He uses examples like Jacinda Ardern's direct communication during the COVID crisis and the Bank of England's efforts to improve transparency to illustrate these points. Ultimately, Carney believes that leadership in a disruptive age requires a focus on long-term sustainability and fairness. He calls for a shift towards purpose-driven capitalism, where businesses prioritize social impact alongside financial returns. He emphasizes the need for collaboration, empathy, and a commitment to building a better future for all generations. He concludes that true progress is moral progress, requiring virtues like humility, humanity, and hope. Chapter 14: How Purposeful Companies Create Value. Mark Carney begins by asking a simple but important question: what does a company truly stand for? He argues that successful organizations aren't just about making money, they need a clear purpose, a sense of why they exist beyond profits. This purpose should guide decisions and inspire everyone involved, from the people who work there to the people who invest in it. A company with a strong purpose earns the trust of society, which Carney calls a social license to operate. Carney emphasizes that leadership is key to building this purpose. Good leaders don't just focus on the bottom line, they create a shared vision and get everyone excited about working towards it. He believes that companies have a responsibility to all their stakeholders, not just shareholders, including employees, customers, and the communities they operate in. This means considering the impact of their actions on the environment and society as a whole. The author uses the example of Josiah Wedgwood, an 18th century potter, to illustrate this point. Wedgwood wasn't just a successful businessman. He cared for his workers, built a community around his factory, and even used his business to advocate against slavery. Carney argues that Wedgwood's success came from understanding that a company's purpose should be broader than just making money. He shows how purpose is especially important during times of big changes, like the Industrial Revolution then, and the technological and environmental challenges we face today. Carney points out that the traditional view of a company as simply a collection of contracts is too limited. It doesn't capture the importance of trust, shared values, and the relationships a company has with its stakeholders. He challenges the idea that a company's only responsibility is to maximize profits for its shareholders, arguing that shareholders aren't really owners in the traditional sense. Instead, companies should be seen as part of an ecosystem, interconnected with all those they affect. The author highlights how crises often force us to rethink our values and what we truly care about. The COVID-19 pandemic, for example, showed how important it is for companies to support their employees, suppliers, and communities. Carney draws lessons from past financial crises, noting that they often reveal underlying problems with how we value things and the risks we take. He stresses the need for resilience, the ability to bounce back from challenges, and for companies to invest in long-term sustainability. Carney advocates for a shift towards enlightened shareholder value, where companies consider the interests of all stakeholders, recognizing that this ultimately benefits shareholders as well. He suggests that companies should integrate environmental, social, and governance (ESG) factors into their strategies and reporting, and that executive compensation should be tied to both financial and non-financial performance. He believes that transparency is crucial, so stakeholders can hold companies accountable for their actions. He explains that a strong corporate culture, where employees feel valued and connected to the company's purpose, is essential. Companies should invest in their employees' development and create a work environment where people feel respected and empowered. Carney also emphasizes the importance of engaging with communities and contributing to the greater good. Carney concludes that building a sustainable and fair future requires companies to embrace purpose, balance profit with values, and take responsibility for their impact on the world. He argues that this isn't just the right thing to do, it's also good for business. By focusing on long-term value creation and building trust with stakeholders, companies can thrive in a rapidly changing world and contribute to a better future for generations to come. He believes that by creating and building, we can solve the big problems facing society today. Chapter 15: Investing for Value S. Mark Carney argues that past crises, financial crashes, climate change, and even the COVID-19 pandemic, all stem from how we define and measure what's truly valuable. He believes we need a better system, one that considers not just profits, but also the impact companies have on people and the planet. Just like after the 1929 stock market crash led to standardized accounting rules, Carney suggests we now need clear rules for reporting climate risks and measuring a company's overall sustainability. What's known as ESG, environmental, social, and governance factors. Carney emphasizes that companies aren't just responsible to their shareholders, but to all their stakeholders, employees, customers, communities, and the environment. He points out that there's a growing movement called ESG investing, which started with simply avoiding bad companies like tobacco firms, but has evolved into actively seeking out companies doing good. These companies are evaluated on things like their carbon footprint, how they treat workers, and how ethical their leadership is. However, Carney cautions that too many different ways of measuring ESG can become confusing, making it hard to see what really matters. The author believes finance should be a tool to achieve societal goals, not an end in itself. Investors need to be clear about what they value, whether it's maximizing profits or creating positive change, and use ESG factors to make informed decisions. He highlights the rapid growth of ESG investing, now exceeding $100 trillion, but warns that some companies might be using ESG labels for marketing rather than genuine improvement. He suggests stricter oversight, like ejecting members who don't follow principles of responsible investment to ensure authenticity. Carney explains that ESG investing isn't just about doing good. It can also be good for business. Companies that prioritize stakeholder value often perform better in the long run because they're better managed, more resilient, and more attractive to customers and employees. He uses the example of energy companies. Instead of simply avoiding all of them, investors can choose to support those with credible plans to reduce emissions. This approach, he argues, can drive the transition to a sustainable economy. The author outlines a spectrum of ESG investing, from simply avoiding risky companies to actively investing in those creating positive social or environmental impact. Impact investing specifically measures both financial returns and social environmental outcomes. He suggests that companies creating value for all stakeholders will ultimately create more value for shareholders. This is because considering all stakeholders can lead to better management, stronger relationships, and a more sustainable business model. Carney points to evidence showing that companies with strong ESG performance often outperform those that don't, especially during times of crisis. He also addresses the question of whether investors have a responsibility to consider ESG factors, arguing that it's not just ethical, but also financially prudent. He believes that investors should understand their clients' values and incorporate them into their investment decisions. Regulations are evolving to support this, particularly in Europe, requiring financial firms to consider sustainability risks. The author stresses the importance of clear and consistent reporting of sustainability information. While financial reporting is well established, sustainability reporting is still developing. He discusses various standards and initiatives, like the GRI and SASB, aiming to create a unified framework for reporting. He envisions a future where companies report not only financial performance, but also their social and environmental impact, allowing investors and stakeholders to make more informed decisions. Carney acknowledges the challenges of measuring social and environmental impact, particularly when it comes to assigning monetary values to things like biodiversity or human life. He suggests focusing on specific, measurable impacts, like reducing carbon emissions and being transparent about the assumptions used in calculations. He highlights the potential of impact-weighted accounts, which would incorporate social and environmental factors into a company's financial statements. Finally, Carney focuses on the transition to a net-zero economy as a major investment opportunity. He argues that investors should actively support companies with credible plans to reduce emissions and measure their portfolio's alignment with climate goals. He believes that this will not only help solve climate change, but also create a new asset class with significant potential for growth. He concludes that investing should be about more than just profits. It should be about creating a sustainable and fair future for generations to come. Chapter 16: How Canada Can Build Value for All. Mark Carney believes Canada has a special role to play in building a better future for everyone. He starts by reflecting on how his experiences abroad made him appreciate Canada's values, integrity, responsibility, working together, and hard work. He feels a duty to help Canada reach its full potential, especially as the world changes rapidly. Carney points out that we're entering a new era, the fourth industrial revolution, driven by things like artificial intelligence and robotics. This revolution could be amazing, but it also risks making inequalities worse. He argues that we need to be careful and design our future with technology, instead of letting technology control us. He uses Edmonton as an example, showing how a city can become a leader in artificial intelligence. He acknowledges past government programs have helped, but stresses the need for faster and better action, always keeping fairness in mind. The author highlights how the COVID-19 pandemic showed Canadians' strong sense of community and willingness to help each other. He believes this spirit, combined with a focus on compassion and responsibility, is key to prosperity. However, he warns that simply continuing as we are isn't enough. We need to be bolder and more dynamic. Carney explains that the way we work and trade is changing. More sales are happening online, and things like software are becoming more valuable than physical factories. But this shift isn't benefiting everyone. Many people are struggling with low wages and job insecurity. He draws a parallel to the Industrial Revolution, when similar anxieties led to social unrest. He notes Canada has done a better job than some countries, like the US, at protecting its citizens through programs like the Canada Child Benefit and universal health care. As a former central banker, Carney understands the importance of a stable economy. But he also knows that economic stability isn't enough. He lists several things that can undermine growth, like too much debt, short-sighted government spending, climate change, and a lack of trust in institutions. He emphasizes that the pandemic has exposed weaknesses in our societies, and that the fourth industrial revolution could worsen inequalities if we don't act. Carney stresses the need for a 10-point plan to address these challenges. He advocates for a shift from simply supporting the current economy to building a new one. This includes investing in green technologies, education, and infrastructure. He argues for responsible government spending and a focus on long-term sustainability. He also emphasizes the importance of resilience, preparing for future shocks, and building a system that can withstand them. The author believes strong institutions are essential for a fair and prosperous society. He explains that institutions are the rules of the game that shape how we interact with each other. He argues that these institutions must be fair, transparent, and adaptable. He points to the importance of competition, intellectual property rights, and a well-functioning financial system. He uses the example of the Libor scandal to illustrate how markets can go wrong and the need for strong regulation. Carney emphasizes the importance of values like solidarity, fairness, responsibility, resilience, sustainability, dynamism, and humility. He calls for policies that support workers, encourage innovation, and protect the environment. He suggests investing in home retrofits to improve energy efficiency, developing hydrogen and carbon capture technologies, and promoting free trade for small businesses. He believes that a focus on these values will create a more inclusive and sustainable economy. Carney argues for a new form of globalization that is based on shared values and respects national sovereignty. He suggests that countries should work together on issues like climate change and financial stability, even if they don't agree on everything. He uses the example of the Financial Stability Board to show how international cooperation can be successful. He concludes by emphasizing the importance of patriotism, a sense of shared purpose and commitment to building a better future for all. He believes that by embracing these values, Canada can lead the way towards a more sustainable and equitable world. And that brings us to the end of our summary of this book. I hope you found it insightful and valuable. If you enjoyed this video, hit like and subscribe for more. Your support helps us bring you more great content. Thanks for watching.